Hello, I'm Carol Alexander. I'm Professor of Finance at the University of Sussex Business School. I'm also visiting professor at Peking University HSBC Business School at the Oxford campus and co-editor of the Journal of Banking and Finance. So welcome to this webinar on corruption fraud in financial markets. Just there. Okay, now why did I choose this topic? Because along with my friend Douglas Cumming from Florida Atlantic University, we've just published an edited book with Wiley's a few months ago, which is 625 pages long, 21 chapters about the different types of practices that are corrupt or fraudulent in different types of financial markets. Not all the chapters could actually be published because some litigation problems against publishing information about, for example, commodity warehousing was not allowing the publication of the chapter. Anyway, that's something else. I'm not going to be talking about commodity warehousing in this talk. What I'm going to be talking about are the evolution of prices in financial markets since the banking crisis, because things have really changed since then. And the behavior of traditional safe haven asset prices like the dollar, supposedly a safe haven, gold, more recently Bitcoin, how they've behaved in the COVID crisis. Then looking at the sort of manipulative trading strategies that can be run by high frequency algorithms, computers actually dealing in financial markets. I'll show you how that happens. I'll be covering regulations and the surveillance of traders and how they've been evolving pretty well actually in the US over the last few years. And then finally, because we're a university, I'll wrap up with the implications of all this for finance degree courses. So let's just set the background of this talk by looking at the new economic order. And I think this is best illustrated by a graph which shows GDP per capita if I set the GDP in each country to be 100 in the year 2000. The red line is China. At the moment, of course, GDP in China is still less than GDP in the US, although greater than it is in the Eurozone. I think it's about 27 trillion in the US, 21 trillion in China, and 18 trillion in the Eurozone. But the growth in GDP is illustrated by this graph. The black and the blue lines are the US and just Germany. That's obviously the main growth country in the Eurozone, the productive economy there. And China has grown from 100 to 1,000, whereas GDP has only doubled in the West. So this really sets the tone for the new economic order, particularly with the impact of COVID, where not only China, but Korea, Singapore, Taiwan, all the East Asian economies have done very well to combat the virus and are now back to 4 or 5% economic growth, whereas the Western economies are being devastated as we speak. So this is the economic reality. Companies are growing very strongly in Asia and not in the West. And this is what's happening to the stock market value of companies over the same period from January 2009 until September 20. So it's going a little bit longer. I haven't got the figures for GDP beyond the end of last year. So it's a different picture. The SSE is the Shanghai Composite Index of Chinese stocks. It's grown 50% in more than a decade. The stocks, that's the main Europe index, has not even doubled, whereas the S&P 500 has grown 400%. So General Motors, for example, Ford. The automotive shares, their book value may not have grown. In fact, certainly hasn't. From the accounting perspective, these companies are as unproductive as they were in the Great Depression. And indeed, the whole US automobile industry has been in dire straits, apart from a brief period when it became the arsenal of democracy, making planes and tanks and guns and everything for the Second World War. So, yeah, what is happening to the US stock market? It seems very odd, doesn't it? The real US economy is full of zombie companies. A zombie company is a company that can't service its debt. Its profits are not enough to pay the interest it owes on debt. And the left-hand graph from the FT in February, as soon as the pandemic hit, estimated that 15% of the largest 3,000 companies in the US were actually zombie companies on the last 3 years of being unable to pay interest on their debts. More generally, Forbes has estimated about 1 in 5 US companies are actually zombie companies. So General Motors, for example, has just been given a $2 billion loan from the US Treasury, and in addition to an accumulation of $16 billion of debt. So we see this with the stock market values of the General Motors and other oil and gas companies, utility companies, and so forth. And this is the real economy. So how can it be that stock market values go up when the book and accounting values of companies is clearly in dire straits? Well, let's have a look at the way the S&P 500 relates to some other economic variables. On the left, you see daily data starting in January this year. The blue line is the S&P 500 again, just showing that 30% decline that happened at the beginning of March, first 2 weeks of March this year, with the outbreak of COVID. On the right, it's the same. The blue is the S&P 500, but the data are only weekly. So I'm comparing on each graph one of the safe haven assets. On the left graph, you see the value of the US dollar against the Chinese yuan. And as the US stocks fell, the dollar appreciated. And as they recovered, the dollar devalued. Now, this isn't the usual behavior. In order to buy, a foreign investor in US stocks needs to buy the dollar. So as US stock demand goes up, so does demand for the dollar. So when the stock market goes up, usually the dollar goes up too. But this anti-correlation we see here is defending the value of US stocks to Chinese investors, and there are a lot of them. But this isn't the typical correlation that we see. Another thing that happens is that when equities fall, there's a flight to gold. But that didn't happen in March at all. In fact, when it was clear that equities were plummeting, so did the gold market. At the time, I was looking at the markets very closely in gold and in cryptocurrencies with my group here at Sussex, the quantitative fintech group. And this graph was produced by a third-year student who was watching it with me, and we wrote a Medium article together showing the dumping of very large contracts on COMEX gold futures. Now, futures markets lead gold bullion prices. And in any market, you'll find there's something called arbitrage, that the futures move first, because that's one thing you can trade, and there's a lot of leverage on that. So very high frequency, large volume trades on the futures, But then another type of trader, an arbitrager, will come and make sure that what we call the basis between the spot and the future doesn't get too big. So on something like the S&P 500, the basis is tiny. If the futures moves, the spot index will move very, very quickly. And how does that happen? It happens through buying the actual stocks, because you can't buy an index itself. You can buy an exchange traded fund on an index, but you can't buy the index unless you hold all the stocks. So these index arbitragers, as soon as the futures moves, they buy the stocks. So if you manipulate the price of the futures, you actually manipulate the price of the stocks. So it's not so close, obviously, in gold bullion. There's not many more contracts. The notional that's traded on gold futures is way beyond what we actually have in terms of gold in the world, in gold bullion. But nevertheless, it still affects the price of bullion. So there was a huge dumping of very, very large contracts from somewhere in order to suppress the price of gold at the time that the S&P 500 was plummeting. And as the index recovered, then these contracts were purchased back. The same thing happened at the same time in Bitcoin. Now, Bitcoin markets are very transparent because most of the trading on Bitcoin, the price leadership, comes from the futures that are traded in completely unregulated exchanges. So these exchanges are domiciled in Malta or Singapore or wherever, the British Virgin Islands, wherever they can escape regulations, particularly from the US. So you can see this plummet in Bitcoin price against the USD occurred at the same time as the gold. And a little comment here about the Exchange Stabilization Fund. I'm still on the background, okay, and then I'm going to get into what's happening with regulators. So going back to the Great Depression, Roosevelt created the Exchange Stabilization Fund when in his Gold and Silver Acts, where the US abandoned the gold standard, and to stabilize the US dollar, there was a lot of currency war going on, devaluations in order to promote exports because of domestic demand in the agricultural sector being so low in the US economy. So there was this devaluation policy, which we're seeing now. The US dollar will devalue to try to promote trade. It's very similar to the Great Depression. Anyway, so the Exchange Stabilization Fund was created for that purpose, but then it was amended a couple of times, actually. In the late 70s, with the approval of the president only, the ESF could deal in gold, as well as foreign exchange, other interests of credit, and securities, stocks and bonds. And following the banking crisis, this was amended further. And the ESF is not at all transparent. It sits within the Treasury, and any profits it makes on dealing in financial markets, it keeps itself. And by February 2020, Congress reported that nearly $100 billion of funds can be used by the ESF for trading in any financial market approved by the president. For example, we know the president doesn't like, the current president doesn't like Bitcoin. So it could well be that the ESF was behind the bashing of Bitcoin. Now, US regulators are really doing some very good things. The CFTC, the SEC, even the FBI is getting involved. So let's have a look at the actions that they're taking against price manipulation. This is from a few weeks ago. The CFTC files against BitMEX. BitMEX is one of the largest derivatives exchanges in Bitcoin. It runs something called the perpetual swap, which until recently was by far the largest derivatives contract on Bitcoin and very much the price leader. And the thing about BitMEX is that they have this very active, what we call lightning channel, that allows Bitcoin and any other crypto to be transferred to their exchange without being recorded on the blockchain. So you think that the blockchain is really transparent, but when you've got this thing called the lightning channel going to BitMEX, then it can be quite secretive. And Dan Berkowitz was recorded just recently at the DAOCOM, the Digital Asset Compliance Board, as saying that he felt that virtual private networks were being used by large US banks and hedge funds to trade on BitMEX. And I'm pretty sure what he meant was that Lightning channel. So let's have a look at that network. This is what it looked like in March 2020. That was when we were watching the markets very carefully. And this BitMEX research, so-called Lightning network, was centered in the UK and extended to the east and west coast of the US and to Asia and Pacific region. In May, I think it was this year, US banks were allowed to be custodians of digital assets, Bitcoin, Ether, and other cryptocurrencies. And very soon afterwards, this is what the Lightning Network looked like. So it's now centered in Wall Street, basically. So that just corroborates what I was saying about possibly using the Lightning Network. Now, how could the price of Bitcoin be moved? This chart shows the BitMEX exchange order book. On the left here, you see the buy and the sell orders in what we call the limit order book. Now, here you can see a very large sell buy order, 1.8 million Bitcoin, and quite a large sell order, 86. This is what it's been doing over time. And this is the current order book. So this very large order is there, and then they stack up the volume behind it. But the actual trades, we don't see any 1.8 million trades. That was quite a large one. Some of the buys are pretty large here. And it's happening very, very quickly. You know, there's 1, 2, 3, 4, 5, 6 in a second. Here, 10 in a second. So when I show you this live trading, you'll see that it's all computers. You can't trade on these exchanges without running an algorithm. But the thing about the spoofing trade is that this order will be taken off in a flash. As soon as somebody here thinks, okay, well, I'll bring my price down just 0.5. All these trades were 0.19, but look, somebody's coming down now to take some of that offer here. And so this is designed to drag the price down. If you see a very large wall of trades on the sell side, they move up and up and up, and they're designed to drag the price up. That's what we call spoofing. Let's have a look and see what's happening at the moment. Okay, so this is live. Okay, same thing's going on, exactly the same. These algorithms, okay, it's too fast to see, all right? So now here, there's a war going on, spoofing on both sides. Okay. Anyway, anybody can look at the BitMEX network. I won't dwell on it now. You just log into BitMEX. You don't even need an account. Now, it's not just on Bitcoin that spoofing is happening. In fact, spoofing's been going on for years and years, even before Bitcoin existed. This is a landmark fine, though. 920 million, that's pretty big, nearly $1 billion fine. Fines by the CFTC are basically usually just about as much as the bank can take. I'll have a look at some of the other ones that they've fined. Sometimes they're pretty small compared with the value of the bank. But this is for spoofing practices over a period of 10 years, affecting various metals futures, gold and silver in particular. Those are the ones that attract the spoofing practices, but also treasury securities, bonds and bills. And there we are, it's just recently, September 29th, 2020. So this is a landmark case for the CFTC. It's taken a long time to actually bring this to justice. But there's lots of other fines. I mean, I just picked out a few. For example, Deutsche Bank, UBS, HSBC, fines for precious metal futures and the S&P 500 futures. So if the S&P 500 is being manipulated upwards and the arbitrages then buy the stocks, this is how it happens. That's why the US stock market has been growing 400%. Equity index futures isn't just banks, it's Tower Research Capital, for example, in London. And there are also other ways in which one, it's not just spoofing, there are ways in which one can influence prices just by printing this thing called tether. This is a subpoena that the CFTC actually brought out in 2018 following this massive surge in the Bitcoin price up to $20,000. What was driving that? Well, it was a company called Tether with exactly the same board as the board of Bitfinex, who were printing Tether and then putting it onto Bitfinex, which was then putting it onto Poloniex, US exchange, onto Bittrex, onto other exchanges, going all the way around the network and basically pumping up the price of Bitcoin by printing Tether. Now, Tether is a stable coin that is supposed to be linked one for one with the dollar. But the collateralization of the Tether company, it should be over $16 billion, because that's how much they've printed by now. And on the left here is a article that I published with one of my PhD students, Michael Dakos, which was also in the Financial Times recently. Other forms of price manipulation, not just spoofing, painting the tape. Here's another way you can manipulate futures, happens to be now on the S&P 500 in this graph, where you collaborate with some friends and say, look, I've got this position, it's on the futures contract, it's going to close out, so I want this, I don't want to close out at this level, I want to close out at this level. So you collaborate with other people to create a lot of volume, other people jump into the market when they see a lot of volume there, and then the actual closing price at 4 o'clock when the futures close gives you a profit. And then you collaborate with your friends in another way when they want to paint the tape. Pumping and dumping. This is very common in crypto markets where you use social media. For example, there are 200,000 new crypto coins and tokens by now. And of course, a lot of them have just died, but the 2018 boom in ICOs, initial coin offerings, has created a massive ecosystem of digital assets now. And when one is coming up in the pre-ICO stage, social media can be used to hype it up, and then the early investors who have bought the coin at a discount will be able to sell it as soon as the ICO goes live, and they dump all their holdings, and then the uninitiated investors who bought the ICO lose all their money. Another way to manipulate prices is using a DDoS attack, a distributed denial of service, where you flood an exchange with computer requests so that it has to close down, and then you have a very, very large limit order, for example, to sell, and it eats up, because the exchange can't take any new orders on, your limit order gets eaten up, and then when the price has gone right down, you've sold it all at higher prices or subsequently lower prices, but you've actually made quite a profit. Then you can buy back, open up the exchange, and then the buy orders will flood in because the price has fallen. So there's so many different ways of price manipulation. What about manipulation of benchmark rates? This is a press release about Goldman Sachs had to pay $120 million for the US dollar is to fix benchmark swap rates. This is on interest rates. Obviously, the LIBOR scandal, everybody knows, Deutsche Bank, Citibank, Barclays. This is foreign exchange. There's lots of class actions against the 4 p.m. foreign exchange fix, particularly the Canadian dollar versus US. It just goes on and on and on. The SEC is involved with insider trading. Here's an action against Morgan Stanley and Goldman Sachs back in 2005, because it's got a lot better since then, actually. They're really tightening up the laddering of IPOs. An initial public offering is where an investment bank underwrites a new share, not a coin, a share. And so the favored investors get allocations of the share in the pre-ICO at very favorable prices, and then they're asked to buy up the price once it goes public. This way, the poor company that asked Goldman Sachs to underwrite the ICO only gets the initial price of the IPO, and then the IPO is undervalued because in the first day of trading, as always, it jumps up. So there's a lot of fines still going on. The penalties to banks directly for underpricing and laddering IPOs are over £1 billion. Disgorgement is the compensation paid to the companies that actually didn't get as much money as they should have in the IPO. That's $3 billion or more. And so this practice continues. And even the FBI are involved. High-speed trading on US stock markets based on insider information. That is a criminal offense, so the FBI gets involved. And so this high-speed trading is everywhere. I showed it to you on currency markets, but it happens on all now the exchanges are electronics, and people are no longer standing on the floor making hand signals, and it's computers that are trading. The closer you are to the exchange, and your fiber optic cable is what matters in financial markets of today. And the actual algorithms you use could be as corrupt as anything. So what are the implications for the next generation? Well, the benefits of algorithmic trading obviously go to those firms like EDF Man and the big banks and the hedge funds, BlackRock and so forth, maybe even the ESF, who have the best high-frequency algorithms and the best connections to the exchanges. But the ordinary investors, unless they've got a very good broker who knows what he's doing, you know, your pension could be eroded. But if you're wealthy enough to have a good broker, by now your pension could have doubled since 2008 in the markets that we've been seeing, or even more than that. If you've just been tracking the S&P 500 with your pension, you would have quadrupled the value of your pension. And the millionaires, well, they're all in the States, aren't they? 18,000 in the States. This was in 2018, probably more now. Obviously, in other countries like China, Japan, United Kingdom, there are 2,000, 4,000, but in the States, there are an awful lot of millionaires. However, when we look at the distribution of income on the left here, we see, for example, this is the bottom 50%. So half the people in the US, the half that have the lowest incomes, together own, they owned $700 million in 1989. Now, together, they own just a few $100 million. That's the bottom 50%, according to income. The top 1% of people in the US used to earn, between them, $8.4 trillion, and now they earn nearly $30 trillion. And how old are these people? Are they young millionaires? Actually not. Mainly, they're in their 50s and 60s. And 70s and 80s. Not only do they have that much wealth, they keep staying in the jobs. They're in government as well. I mean, look at the president. But in the whole of government is run not by young people, but by old people that are taking massive salaries as well as accumulating this. the scope for young people to move into employment. What have we done to this generation? Look at youth unemployment since 2008. It wasn't growing since 2008. This is for the world as a whole. It's gone up from about 13% to 15% on average over the last 10 years. This is what it looks like in terms of geographical distribution. It's pretty high in Europe, in Asia, in India, not so high in the UK or the US or China, but still it's been growing in all these countries. And what we can see as effect of COVID is mass unemployment is going to happen in the Western economies in Europe and the US, and it's going to be hitting the young people in particular. So what does this mean? Well, I grew up, I was your age, if you're young, if you're thinking about Sussex as a potential place to study, which I did. I was an undergraduate at Sussex. And when I finished my degree, there were very few jobs available. But my professor, who became my PhD supervisor actually, he said to me, when there are very few jobs, and he'd grown up in Berlin before the war, okay, Walter Lederman was his name. And he said to me, well, when there aren't very many jobs, the thing to do is qualify, get more qualifications. So when the jobs come along, you are ideally positioned for the jobs that are available. And that's what I did. And I'm very glad I took his advice. So this is what I advise the young people of today, to take a qualification that's going to put you there for the jobs when they are available. But be careful, because many finance degrees are still teaching efficient markets, equilibrium economics, the capital asset pricing model, fundamental factors. And we've moved away from that. We need to teach people about fintech, algorithmic trading, blockchain, cryptocurrencies, ethical trading. This is what we teach in our new degrees at Sussex, and this is what you should look for when you're looking for a new course to take. So if you're interested to find more about what we have at Sussex, then this is the Department of Accounting, our department. We have many undergraduate, postgraduate degrees. And that's it. I think I've taken about half an hour, yeah, as planned. So here are our contact details, and I'm ready for any questions in the Q&A. Okay, here's a question. Can you explain what spoofing is again? Okay, so spoofing is putting on a trade that in the limit order book just below the last traded price or just above it, depending on which way you want to move the price. And it's a very, very large trade, but it's a fake trade, and it's put on by a computer program that will just be flashing there for a microsecond to look like there's a trade. And you try, if somebody who wants to sell and just moves down a little bit to take that buy order, it'll be gone by the time you put on that trade. Okay, so it's a spoofing trade. It's like a ghost trade. There are lots of other forms of testing the market as well. It's called pinging. This is in foreign exchange markets. Spoofing and pinging occurs, where you go deeper into the order book to test how much interest there is in large trades away from the market price. How often have exchanges had to be closed due to flooded orders? Okay, so DDoS attacks on crypto exchanges occur all the time, every week. For example, Coinbase, one of the largest exchanges, had to close, I think it was yesterday or the day before. OKEx, another very large one. These cyber attacks really are happening with alarming frequency. And of course, whilst the defenses are coming up more and more, it's still possible to get round them. Now, how useful would a degree in business analytics from the UK be given the current market scenario? Business analytics. I'm not an expert in business analytics, so can't really answer that question. I'm an expert in risk management, but now I've moved more towards microstructure and corruption and, you know, malpractice, and also fintech. I can advise you on fintech. In terms of qualifications outside of going on to complete a master's, what would you recommend? Primarily individual research, or are there any bodies who provide certified qualifications? Yes, there are. Obviously the CFA, that's this long-standing qualifications, but you also look at the CQF. Paul Wilmot has run the quantitative one, which is a little bit more geared towards fintech. We haven't yet managed to develop a proper fintech qualification. I'm talking with my contacts in America and Australia with a view to developing, as I did for risk management, I developed the professional risk managers qualification with the handbook, and my plan is to create this industry standard in fintech, but I haven't had a chance to do that yet. Do you think there's no place in modern finance for CAPM and EMH anymore? That's a very good question. Well, I think there is a place, just from a historical perspective. For what, you never know, there is an equilibrium somewhere. If we, you know, not all markets are as corrupt as the ones I've been talking about. So I think that classical financial education does need to be taught, but we do teach it at Sussex. We have our investment theory course, which covers all that, as well as mean variance, portfolio optimization, and all this stuff, of course. But I don't think we should put so much emphasis. We need to move with the times to innovate our courses on an ongoing basis. And so we should be agile and every year bring on new things, for example, ethical trading or whatever. Spoofing is hidden or facilitated by tiny orders only. Well, spoofing isn't hidden on those exchanges like BitMEX where you can actually see it happening. But the order books on like the NASDAQ or something, I mean, they're held in these massive warehouses, which only the regulators would have access to. And also the identities of the traders there it's a sort of forensic examination. What material would you recommend to catch up in pace with business and economy? FT. And I get all my information from the Financial Times, Wall Street Journal. I have feeds where they for example, I'm following the Chinese economy quite a lot at the moment, obviously, because it's certainly the emerging economy. And what's happening in the South China Seas is very concerning, particularly when you've got a madman like Trump in charge. How useful do you think it is if we have some knowledge on fintech in the future market? Will it enhance our employability? Oh yeah, you bet. I mean, when you look at the jobs on offer, if you just go onto any jobs board, most of them are fintech. And it was, about a year ago, there was a lot of demand for jobs for Python programmers only. But fintech more generally, knowledge of the blockchain and startup companies, the startups, the ICOs in 2020 are really changing. I didn't put a slide in for that, but I'm teaching it in my current module lecture. I just was doing my pre-recorded lectures because that's what I'm doing for 20-minute slots now for my students. And I was looking at the ICOs in 2020. And they are massive. I mean, they are billions of ICOs. So big companies all over the world and doing these startups. So fintech startups have become very big, and these are the main source of employment in many countries. would you be able to, or is there advisors available in the business school to give advice on building our own portfolios if we're looking to begin investing? Yes, we do that in our master's course. We also have an investment club where you can do it without any sort of official involvement, but you run a paper portfolio in the portfolio management module, and then part of the assessment is to run that portfolio on paper and then look at the performance using things like Sharpe ratio, Sortino ratio, and this sort of thing. And then you give a presentation as if you are a company with a group. Okay. How would somebody go about learning algo trading? Well, you first of all, you need to know how to program in Python, because nothing else is going to be quick enough. And then you need to know about the algo trading strategies. Now, we have a module called Trading Strategies in it's a third year option, where a local firm, OSTC, we have a lot of links. In fact, they employ quite a few of our graduates. They teach people about trading strategies. They're not these OSTC are completely opposite to corrupt high frequency traders. They have very, very strong surveillance and education of their traders. So they're one of the most ethical traders around. They also have education, Zishi learning, which tries to explain about algo trading. So we can connect you with those as well if you want, but also how not to break the rules with algo trading. Do University of Sussex Business School provide fintech courses at undergraduate level or master's level or PhD level? Yes, all three, although the PhD is not a course, but I have a couple of first year PhDs who are doing their dissertations. One of them is in microstructure, currently on crypto markets. Another one, we've just been developing the Bitcoin VIX, which is about to go live with Crypto Compare. And so we work very closely with the industry as well at PhD level. But we have BSc FinTech, we have MSc FinTech Risk and Investment Analysis. These are all available on our website. To go to risk management, what kind of masters would you suggest? Are risk management masters teaching algorithmic trading, or would you suggest something like computer science master? Well, we have our masters in fintech risk and investment analysis has 3 streams. So you can specialize in risk management or portfolio management or fintech. So that's a good one. When I was at Reading, I moved from Reading back to my alma mater in 2013 when the business school here started. But at Reading, I introduced the first risk management masters, which is now run by one of my ex-PhDs, Emma Schiller-Zar, and that's been going for, I think it was the first masters in risk management. You can take a professional qualification in risk management, the PRM, as I said, I developed that, but also there's the GARP qualification. That's another one you could take. A computer science master is always very, very good, but you have to be very careful, because if you take a computer science master, which is taught by some department that doesn't have any idea what the applications are in finance, then you end up just being, you're just a programmer. You need the knowledge of finance to progress in your career. So I've had students that have gone on to do a computer science master's, and then they had to come back and get a master's in finance, because without that, they were just programming all the time and they didn't want to do that. I've seen a lot of graduate junior roles asking for experience in SQL. Okay, that's the data analysis roles. Does this business school offer any kind of course in SQL? I haven't come across it in any of my modules yet. I'm currently learning to use Python, but SQL seems to be more in demand. I can't answer that myself. So if I were you, I would get in touch, depending on the level. If you want to get in touch at the master's level, contact Ding Chen at Sussex. If you want to get in touch at the undergraduate level, contact Usama Baha, and they'll be able to tell you about this. Will the blockchain really become the next big thing, as suggested 5 to 7 years ago, or is it just a buzzword that will fall out of favor when a new tech term is introduced? why does blockchain seem to be taking such a long time to revolutionize markets and databases when it was introduced a relatively long time ago? Okay, well, there are two types of blockchain, private and public. The public blockchains do take a long time to develop because Bitcoin, which was introduced, as you say, a very long time ago, was just an experiment. It used something called proof of work consensus, which eats up all the electricity on the planet. It can't scale so that you can process 70,000 transactions per second that Visa and MasterCard can. But the newer blockchains, the Ethereum 2, EOS, Polkadot, and things like the Tangle, the IOTA, which isn't actually theoretically a blockchain. It's an amazing thing, the Tangle. These are obviously going to underlie the Internet of Things, and the Polkadot, the Polkadot unifies and sort of makes all these different blockchains with different consensus algorithms, what we call interoperable. This is a very long process. Nevertheless, Web 2.0 is broken. It's hackable. The API, the application programming interfaces, are not secure. When I log onto Facebook or my bank, I put in my details and it goes through an insecure API to an insecure database that anybody could hack. This is why it needs to be on a blockchain. And Web 3.0, which is actually evolving as we speak, you may be logging onto a website which is actually information is transferred by a secure smart contract, which is coded on a blockchain. And the database is coded on a blockchain, can't be changed, it's immutable. And you wouldn't know because it's what we call a DApp, a distributed app, which is not the same as an app. But it looks the same, the interface is the same. So Web 3.0 is growing, it's coming, and it's all blockchain powered, but you just can't see it right now. On the other hand, we have private blockchains, which are used by banks, central bank digital currencies. They are on private blockchains. These are just like distributed ledgers that are a bit easier to manage. Global supply chain is run now by private blockchains. They don't need this consensus algorithm, so they're not. You still need to trust the central counterparty, like the central bank for the CBDC, or if you've got an interest rate swap that's coded with a smart contract on a private blockchain, you still have to trust that whoever's running that blockchain doesn't interfere with the program. Final one now, because I have my students coming in 10 minutes for a synchronous lecture online. So final question, what is your view on the Chinese digital currency? Okay, so the People's Bank of China just announced this week that they're changing the law to make it possible to replace cash completely with a digital currency. In fact, they're not the first. Earlier this week, the Bahamas came in with the sand dollar, which is available to all residents in the Bahamas, and it can be used through mobile phones, and you can go in with your mobile phone with any merchant that's got the proper app on their mobile phone. And instead of the sort of M-Pesa thing where mobile phone minutes are the currency as used in parts of Africa because they don't trust the bank, the central bank has allowed residents of the Bahamas to use the mobile phone with the sand dollar as the currency. Now, the Central Bank of China have been talking about digital currency longer than any other central bank. CBDCs are the flavor of this year. Stable coins were last year, IPOs were the year before, but CBDCs, 85% of central banks are now talking about introducing digital currencies. But the People's Bank of China was the first to actually really start moving towards digital currency about more than 2 years ago. They're planning to introduce it as a complete replacement for cash. The difficulty, of course, is that it's much more transparent, and money laundering is much more difficult if there is no such thing as cash, and you can't hide cash you can't hide a digital currency in a suitcase or export it in a statue. So it will happen, and it will make life a lot easier for some people, but a lot more difficult for others. Such is life. Okay, so I think that's enough for now. I need to prepare for my lecture for my students who are just about to log on to Zoom. So bye for now. Thanks for joining.